In this week's video, we'll examine the good, the bad, and the ugly. Let's get the bad news out of the way first, therefore we'll start with the ugly. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a chart we've covered before in the videos. We're looking at the ratio of risk-on stocks, SPY, relative to risk-off bonds, or TLT. This is the ratio here in the middle. This is the S&P 500, and this is RSI for the ratio. The market bounced here at this blue line as the ratio bounced. We got a bounce in the ratio here. Stock market bounced. Bounce in the ratio here. Stocks rallied. Bad news. This looks ugly. We had a breakout in favor of treasuries, and this is why in the vast majority of client accounts we added to our existing TLT holdings during the week. This is the bad news. The good news is this chart is used in the market model, but it does not carry a high weight. Why is that? Because its correlation to the S&P 500 is somewhat mixed. So it's not a total disaster for stocks that this broke in this direction, but it's not good news, and it is good news for holders of TLT relative to SPY. So what this is telling us is we have to go into next week, and if price breaks down, we have to be willing to make additional defensive chess moves, and we might have to make them at a faster rate now based on the evidence. A better reference point, or a ratio that has a better and stronger and more consistent correlation with the S&P 500, is SPY relative to AGG. And as you can see, this chart looks a lot better from a risk-reward perspective. What once acted as resistance may now act as support. And we also have this falling wedge look here in the ratio. For those of you that are new to the markets, you could go to stockcharts.com and look for falling wedge, and they'll talk about it. But a falling wedge pattern can be a reversal or bullish pattern. So this gives us some hope that this ratio might potentially bounce. From a negative perspective, this is a lower low, this is a lower low. A series of lower lows and lower highs is not what we want, but it can help us make the point that although the evidence and momentum is clearly starting to roll over towards the bearish side of the ledger, charts always look ugly until they start to improve. For example, if you looked at the charts on October 14th, the day before the stock market bottomed on October 15th, the charts looked terrible. And most people would have read them as bearish charts. Charts can change at any time when the news or inputs change, and that can happen, and that's why we have to remain flexible. But at the same time, we have to acknowledge the evidence that we can see in front of us, and hence why we've made some defensive moves and may have to make more if the charts don't improve. Those concepts give us a natural segue into the good. We're looking at the daily chart of the S&P 500 that we've been using for several weeks to help manage risk and reward. The good is that the most important thing, bar none, is price. Price captures everything. We know this with 100% certainty, and you can't say that about many things in the financial markets. If we are to go into a 3-week correction, a 3-month correction, or a 3-year devastating, hard to recover from bear market, it is not physically possible for any of those 3 things to happen until the S&P 500 makes a lower low on a closing basis on this chart. As you can see, it has not made a lower low relative to this trend channel. We're very, very close. A lower low on a closing basis would be below this level, and if we wanted to be conservative, it would be below this level here, which would be 1988. Therefore, if you're a client, if we close below 1988 on Monday, the rules and the evidence will require us to make additional defensive changes, and we will be making them at a relatively fast rate based upon the evidence, cutting stocks again and possibly adding to our bond, cash, and/or currency options on the other end of the spectrum. We closed Friday above the 38.2% retracement level. These levels are described in this post on our blog, Short Takes. If you Google this title here, you can find it. Under our system and using our approach, we don't make predictions about what is going to happen next. So we're not saying that the market will not break down. It very well may break down. That's a possibility. It's also a possibility that the trend channel holds, or this Fibonacci level holds, or one of these levels down here holds. So we'll keep an open mind, and if needed, we will take action early and often next week. If the market can bounce here, then we can remain patient. This is the weekly chart of the VIX Fear Index here. This is the VIX, this is the S&P 500. We've covered this several times, so just a quick update. This chart also aligns with the it is prudent to remain patient until the VIX moves into this level here. The VIX continues to make a series of lower highs. That's declining fear about future volatility. The bears want it to move into this level, which it very well may do. It just hasn't happened yet. We recently compared the German DAX to the highly correlated S&P 500. U.S. stocks and the DAX, for the most part, tend to zig and zag together. They can diverge for a time, but typically they don't diverge for long periods of time. This is a daily chart of the DAX. You can see we had somewhat of an inverse head and shoulders pattern. This could be your left shoulder. This V bottom here could be your head, and this mess over here could be your right shoulder. We have a very similar pattern that's been playing out in the broader NYSE composite. And again, that's relevant because these indices tend to be highly correlated over the long run. We've got similar little hiccups here. Then we have another low, similar. This is a higher low. This is a higher low relative to this low. After this point here, what happened in Germany? The answer is the DAX from this point here popped 15% and did break out in a bullish manner. If we did that from this point here, roughly on the S&P 500, a 15% pop from that level would take us to 2287. Obviously, we had QE announced in Europe. However, that applies to the United States as well, and these two indices process global information all the time, and over the long run, especially if you look at a monthly chart, their correlations between the DAX and US stocks tend to be very, very high. Therefore, this breakout from a probabilistic perspective and these patterns tell us to keep an open mind despite the horrible and ugly look of the charts right now about the potential for some improvement starting next week. The following charts will help us summarize the bad. This is the broad NYSE Composite Stock Index. It's a daily version. We'll use it to illustrate some concepts, including the overriding concern or problem mathematically with this market. We'll cover some pullbacks and then put some context around them. When the market pulled back in October of last year, it wiped out 392 calendar days of gains, meaning if you went back 392 calendar days, the market was in the exact same place. When the stock market pulled back in mid-December of last year, it wiped out 354 calendar days of gains. Point to point, December 26th, 2013. 2015 has been deja vu all over again. The recent pullback here wiped out 320 calendar days of gains. If we add some moving averages to the chart, we can help define the mathematical risk that's been piling up. This is the 50-day moving average in blue, the 125-day in green, and the 200 in red. Here, when we pull back, our risk is much, much lower. Why? The longer term and intermediate term trends are healthier. Here, it's a little bit riskier. Now we've gotten to a point, instead of this blue line having a steep bullish slope, green line, steep bullish slope, red line, steep bullish slope, we have all three of them flattening out and or rolling over, telling us that a pullback into this area here is a much higher risk pullback than a pullback into this area here. Therefore, if you're a client and we break these levels mathematically and from a risk reward and risk management perspective, we'll be making some pretty big moves in terms of cutting equity exposure and either adding to cash or adding to more conservative assets. This is indecisiveness. It's also telling us that if we're patient, we can't throw out the DAX scenario that says the indecisiveness could break in a bullish manner as well. In terms of our model and the frustrations with this market, the issue is not these pullbacks. This type of pullback is actually quite common. It is not uncommon for a market to come back and wipe out a year or two of gains. The model properly scaled away here, and we properly scaled back in. The problem has been the market has failed to go on and make a new high here, and that's where the frustration comes in. We come down, properly scaled back in, but we're not getting the new high. Here we're patient, come back up, we're not getting the new high. So we need to see some resolution here. What we need under our approach is for this indecisiveness to break one way or another. We really don't care which way it breaks. What we would like to see is a 3-week or 3-month rally in this direction, or a 3-week or 3-month correction in this direction to get away from this indecisive, zigzaggy type behavior. And eventually, if we stick to our discipline, the market will do one of those two things. It's extremely important to continue to execute faithfully into the letter of the law during these frustrating periods, and that's what we're doing. Now we're looking at the ratio of the S&P 500 SPY to a currency hedged European stock ETF, which is HEDJ. You can read more about it here. Purpose of the exercise. We said last week we really hadn't seen enough to consider moving or toward or considering European stocks. That's not true anymore. This is an uptrend here on a weekly chart in favor of SPY. It broke down. The purpose of showing this, if the U.S. markets and risk in general can right themselves and we start to move in this direction more like the DAX, this type of investment, or Europe in general, is something that's on our radar and something that we would consider. This puts some context around the decisions that we'll have to make if the stock market continues to be weak or if it continues to be strong. Now we're looking at HEDJ relative to U.S. Treasuries, and you can see that the risk off or more conservative TLT is still the winner versus HEDJ. And the purpose of showing this is, regardless of what the stock market does and what levels hold or don't hold, we still have a whole nother part of the market model, the ETF scoring system, that helps us with opportunity cost decisions. Is this a good place to be? Yes, potentially, if the trends turn. Is it the best place to be? Not right now. I'd rather be in TLT. So we'll have to look at numerous charts and consider numerous inputs regardless of whether the S&P holds or not. We'll use a few charts here to take some of these concepts a little bit further. We own retail XRT. It's been a good decision. We had the bullish breakout here, and since that breakout, retail has outperformed SPY. So this chart looks good, but this isn't the only chart that we would look at. If we compare retail head-to-head with TLT or long-term treasuries, you can see they were battling and consolidating and indecisive for several months. The box here bounded that battle. Last week, the ratio broke out in favor of TLT, so everything is an opportunity cost. As long as this chart has a look like this, we would be willing to swap out something like an XRT under any conditions and move into something potentially more favorable, which could be TLT. It might be something else. We're always thinking 2 or 3 chess moves ahead, so let's make some assumptions. Let's assume that the stock market breaks the support levels next week and we raise some cash, and let's say hypothetically on Monday or Tuesday we sold XRT, and then the market whipsawed us, stocks rallied. That's not the end of the world. What you want to do in that case is find what your replacement would be if you're wrong. Here's an example. It's possible under that scenario that we might prefer to own something like an HEDJ relative to XRT. You can see this is an uptrend here favoring retail that was recently broken. Not saying we're going to buy this, we're just using it as a hypothetical example of the thought process. Same exact concepts here. We own small caps IJR. That's been a good move recently. You can see that the ratio has been rising and is in a bullish weekly trend, saying IJR is trending relative to the S&P 500. However, small caps recently broke down relative to TLT. We own both of these. We own more of this, and this is one of the reasons why. This chart here is also telling us that we better have, and we do have, several defensive chess moves lined up in case the market can't right itself and equities break to the downside. We'll close on a more positive note for the bulls. We did finish the week, Friday, January 30th, above this pink band of possible support that we've been watching between 1976 and 1988. We'll keep an open mind about what happens next. We could bounce in this direction like the DAX, or we could break into this area here and correct further. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.